Question 1. The price an investor pays when purchasing shares of an open-end management company, mutual fund, that levies a front-end sales charge is best described as the A. Net asset value, NAV. B. Public offering price, POP. C. Bid price. D. Redemption price. Answer B. Public offering price, POP. When a mutual fund charges a front-end sales load, the price the investor pays is called the public offering price, POP, which is calculated as the net asset value, NAV, per share plus the applicable sales charge. The NAV represents the fund's asset value per share, but the investor must pay the additional load to the underwriter for the service of buying in. Open-end funds are continuously offered to the public, and the POP is the ultimate figure the investor must tender to acquire the shares. A key takeaway is that the POP is always the purchase price for a loaded fund, while the NAV is the value used for redemption. Question 2. A registered representative must receive specific principal approval for which of the following activities? A. Mailing an annual report to an existing client. B. Sending an email to an individual client detailing a municipal bond offering. C. Preparing a new retail communication regarding a variable annuity product. D. Providing a preliminary prospectus to a potential new investor. Answer C. Preparing a new retail communication regarding a variable annuity product. All retail communications, defined as any written or electronic communication distributed to more than 25 retail investors within a 30 calendar day period, must be approved by a qualified principal prior to first use. This pre-approval requirement is a FINRA rule designed to ensure that all public-facing materials are fair, balanced, and not misleading, which is particularly important for complex products like variable annuities. Sending a new communication is considered a high-risk activity due to its broad reach, while sending existing, already approved documents like annual reports or preliminary prospectuses is typically a ministerial task that does not require fresh pre-approval. Always remember that communicating with the public carries the highest regulatory scrutiny, necessitating principal sign-off. Question 3. Under the Investment Company Act of 1940, an open-end investment company is legally required to offer the right of redemption to its shareholders within what period after receiving a request? 3 calendar days. B. 7 calendar days. C. 15 business days. D. 7 business days. Answer D. 7 business days. The Investment Company Act of 1940 mandates that mutual funds must redeem, buy back, their shares from investors and pay out the proceeds within 7 calendar days of receiving a redemption request. This legal requirement ensures the liquidity of open-end investment company shares, which is a fundamental difference between them and other security types. While the calculation of the net asset value, NAV, often happens at the close of the trading day when the order is received, the actual payment period is strictly defined as 7 calendar days. Keep in mind that a mutual fund investor is guaranteed the ability to sell their shares back to the fund at the next calculated NAV. Question 4. An investor purchasing a Class B share of a mutual fund would most likely be subject to which type of sales charge? A. Front-end load. B. Level load. C. Deferred load or contingent deferred sales charge, CDSC. D. No load. Answer C. Deferred load or contingent deferred sales charge, CDSC. Class B shares are typically characterized by a back-end sales load, known as a contingent deferred sales charge, CDSC, which decreases to zero the longer the investor holds the shares. The shares are purchased at the net asset value, NAV, with no initial sales charge, but the CDSC is incurred only if the shares are redeemed, sold, before a specified holding period such as 5 to 7 years. This structure is best suited for investors with a long-term time horizon who plan to hold the investment until the CDSC drops to zero, thereby avoiding any sales charge. Remember, the letter B often stands for back-end load, while A is for front-end load, offering an easy memory tool. Question 5. In a variable annuity contract, the number of accumulation units owned by the investor is calculated based on which factor? A. The total value of the investor's subaccounts, divided by the number of annuity units. B. The monthly premium payment divided by the number of shares in the fund. C. The current value of a unit, divided into the amount of money invested. D. The assumed interest rate, AIR, divided by the investment return. Answer C. The current value of a unit, divided into the amount of money invested. The accumulation period of a variable annuity is where the investor's contributions are invested and grow on a tax-deferred basis, and the number of accumulation units purchased is determined by dividing the dollar amount of a premium payment by the current value of a single accumulation unit. The accumulation unit value fluctuates daily based on the performance of the chosen investments, similar to a mutual fund share price, and the total number of units held determines the investor's interest in the separate account. This phase contrasts with the annuity period, where a fixed number of annuity units are used to determine the payout amount. Always connect accumulation to the period of contribution and growth, where the number of units is variable and growing. Question 6. All of the following are characteristics of a non-qualified retirement plan, except A. Contributions are made with after-tax dollars. B. Earnings grow tax-deferred. C. The plan may be discriminatory and offered to select employees. D. The plan requires IRS approval for its establishment. Answer D. The plan requires IRS approval for its establishment. Non-qualified retirement plans such as payroll deduction plans or deferred compensation arrangements do not require IRS approval for their establishment because they are not governed by the Employee Retirement Income Security Act, ERISA. The defining characteristics of a non-qualified plan are that contributions are typically made with after-tax dollars, earnings grow tax-deferred, and most notably the plan can be discriminatory, allowing the employer to offer it only to select, often highly compensated employees. The key difference is that qualified plans such as 401(k)(s) receive tax deductions for contributions and must meet non-discriminatory participation standards, requiring specific IRS rules. Question 7. The primary difference between an open-end investment company and a closed-end investment company is that open-end funds issue a fixed number of shares, while closed-end funds continuously issue new shares. B. Open-end funds are generally managed passively, while closed-end funds are managed actively. C. Open-end funds are redeemed by the company, while closed-end fund shares trade in the secondary market. D. Open-end funds are subject to the Investment Company Act of 1940, while closed-end funds are exempt. Answer C. Open-end funds are redeemed by the company, while closed-end fund shares trade in the secondary market. The essential difference lies in the capital structure and trading mechanism. Open-end funds or mutual funds issue a continuous flow of new shares and stand ready to redeem, buy back, those shares from investors, pricing them based on the daily net asset value, NAV. In contrast, closed-end funds issue a fixed number of shares in an initial public offering (IPO), and these shares subsequently trade between investors on a stock exchange or over-the-counter (OTC) market, often selling at a price above or below their NAV. Remember that open-end funds are perpetually open to new money and redemptions, while closed-end funds are closed after the IPO and trade like normal stock. Question 8. A variable life insurance contract generally includes a minimum death benefit that is not guaranteed as it depends entirely on the performance of the separate account. B. Guaranteed only for the first 5 years of the contract. C. Guaranteed to be at least the initial face amount of the policy. D. Tied to the Consumer Price Index (CPI) and adjusted annually. Answer C. Guaranteed to be at least the initial face amount of the policy. Variable life insurance policies offer a minimum guaranteed death benefit, which ensures that the policy will pay out at least the initial face amount of the policy, regardless of the performance of the underlying investments in the separate account. While the cash value and the non-guaranteed portion of the death benefit fluctuate with the separate account's performance, this guarantee is a key characteristic that distinguishes life insurance from a pure investment product. This guarantee provides a necessary safety net for the policyholder's beneficiaries, ensuring a minimum payout is always available. The main risk to the policyholder is that the cash value is not guaranteed and can decline based on investment performance. Question 9. To qualify as a diversified management investment company under the Investment Company Act of 1940, a fund must adhere to the May 10, 1975 rule regarding its portfolio holdings. The rule relates to which calculation? A. The maximum percentage of the fund's portfolio that can be invested in fixed income securities. B. The maximum percentage of the fund's assets that can be held as cash equivalents. C. The percentage limits on the investment of the fund's assets in a single issuer. D. The minimum percentage of the fund's board of directors that must be independent. Answer: C. The percentage limits on the investment of the fund's assets in a single issuer. The May 10, 75 test defines a diversified management company. At least 75% of the fund's total assets must be invested in a way that no more than 5% of the total assets are in any one issuer, and the fund cannot own more than 10% of the voting stock of any single issuer. These specific percentage limits are designed to force diversification across many different companies, thereby spreading risk and ensuring the fund doesn't become over-reliant on the success of one or two holdings. This is a critical regulatory standard used to market funds as properly diversified. Question 10. A registered representative is presenting performance data for a mutual fund to a retail client. When showing long-term performance, the representative must present the total return for which three standard time periods. A 1-year, 3-year and 5-year periods. B. 1-year, 5-year and 10-year periods. C. 3-year, 5-year and 7-year periods. D. 5-year, 10-year and 20-year periods. Answer B. 1-year, 5-year and 10-year periods. FINRA rules mandate that a registered representative must show a mutual fund's performance data for the 1-year, 5-year and 10-year periods, or for the life of the fund if it has existed for a shorter time, to provide a balanced and comprehensive view. This standardized requirement ensures that investors can compare different funds fairly using consistent, verifiable data and helps prevent cherry-picking the best-performing periods. The performance must also be calculated on a total return basis, reflecting all capital gains distributions and dividends, and be net of the highest applicable sales charge. Question 11. Which of the following parties is primarily responsible for the safekeeping of a mutual fund's cash and securities? A. The fund's transfer agent. B. The fund's custodian. C. The fund's investment advisor. D. The fund's underwriter. Answer B. The fund's custodian. The custodian is an institution, usually a commercial bank, responsible for physically holding the fund's assets, such as cash and securities, and performing mechanical duties like handling payments and receipts. This separation of asset custody from the management and selling functions is mandated by the Investment Company Act of 1940 to prevent the misuse of fund assets and protect investors. The investment advisor manages the portfolio, the transfer agent maintains shareholder records, and the underwriter handles the sales and marketing, but the custodian is the actual safekeeper. Question 12. A registered representative can sell a variable annuity to a client without an active insurance license in the client's state under which circumstance? A. The representative is licensed in a neighboring state and the sale is conducted entirely by mail. B. The sale is to an institutional client who has other existing insurance products. C. A variable annuity is a security, so only a FINRA Series 6 or 7 license is required. D. The representative must hold both a state insurance license and a securities license, like the Series 6, in the client's state. Answer: D. The representative must hold both a state insurance license and a securities license, like the Series 6, in the client's state. Because a variable annuity is considered both a security and an insurance product, an individual selling it must be licensed with both the state insurance department and FINRA, typically with a Series 6 or 7 license. State insurance laws are critical, and a representative must be properly licensed in the state where the sale is transacted with the client, even if they hold an active securities license. This dual licensing requirement ensures the representative is knowledgeable about both the investment risk aspects, governed by FINRA, and the contract features and guarantees, governed by state insurance law. Question 13. A key benefit of an individual retirement account, IRA, contribution being tax-deductible, is that it A. Lowers the investor's current year's taxable income. B. Allows for tax-free withdrawals in retirement. C. Increases the maximum contribution limit for the year. D. Exempts the account from all future capital gains taxes. Answer: A. Lowers the investor's current year's taxable income. A tax-deductible contribution to a traditional IRA means that the amount contributed can be subtracted from the investor's gross income, thereby reducing the amount of income subject to tax in the current year. This immediate tax break is a primary benefit of traditional IRAs, offering a form of incentive for saving for retirement. This contrasts with a Roth IRA, where contributions are made with after-tax money, not deductible, but all qualified withdrawals in retirement are completely tax-free. Question 14. Which document must be provided to a potential mutual fund investor no later than the time of sale? A. The fund's annual report. B. The Statement of Additional Information, SAI. C. The statutory full or summary prospectus. D. The fund's marketing brochures. Answer: C. The statutory full or summary prospectus. The Securities Act of 1933 requires that any person solicited to purchase a mutual fund must receive the fund's statutory prospectus, or a FINRA-approved summary prospectus, no later than the time the sale is confirmed. The prospectus contains all material information necessary for an investor to make an informed decision, including investment objectives, risks, fee structure, and performance history. This delivery requirement is foundational to investor protection, ensuring that the necessary disclosures are made before the transaction is finalized. Question 15. The investment return from a variable annuity is based on the performance of the A. General account of the insurance company. B. Investment portfolio of a separate account. C. Assumed interest rate, AIR. D. Standard & Poor's 500 Index. Answer: B. Investment portfolio of a separate account. The performance of a variable annuity is directly tied to the performance of the investment portfolio held within the insurance company's separate account, which is segregated from the general account used to fund the company's guaranteed obligations. Since the separate account's value fluctuates based on the performance of the underlying subaccounts, which operate like mutual funds, the contract owner bears the investment risk, and the contract's value is considered non-guaranteed. This direct link to market performance is what classifies a variable annuity as a security, necessitating a securities license for its sale. Question 16. A rights of accumulation privilege in a mutual fund allows an investor to A. Combine the assets of family members to qualify for a reduced sales charge. B. Use the total value of shares already held to qualify for a lower sales charge on new purchases. C. Reinvest all dividend and capital gains distributions without paying an additional sales charge. D. Purchase fund shares at the net asset value, NAV, with no sales charge. Answer: B. Use the total value of shares already held to qualify for a lower sales charge on new purchases. Rights of accumulation is a mutual fund benefit that allows an investor to qualify for a reduced sales charge, a breakpoint, on any new purchases by counting the value of the shares they currently own in the fund family toward the required investment level. This privilege is prospective, meaning it applies only to future purchases and not retroactively to past transactions. This feature encourages investors to keep their money within the fund family, making it easier to reach higher-tier breakpoints over time. Question 17. The primary purpose of a mutual fund's 12b-1 fee is to cover A. The fund's portfolio management and trading expenses. B. The cost of the fund's custodian and transfer agent services. C. Marketing and distribution expenses. D. Shareholder service fees and administrative costs. Answer: C. Marketing and distribution expenses. A 12b-1 fee is a charge deducted from a mutual fund's assets to pay for the costs of marketing, distribution, and promotional activities, which can include compensating registered representatives for selling the fund. This fee is a type of asset-based sales charge, meaning it is assessed annually as a percentage of the fund's average net assets. Investors should note that a fund can only be marketed as no-load if its 12b-1 fee is 0.25% or less, which is an important regulatory threshold. Question 18. An associated person must notify FINRA, through the employing broker-dealer, of participation in a private securities transaction only if the person receives A. Compensation for the transaction. B. Written approval from the customer. C. A written notice from the SEC. D. Notification from the broker-dealer's compliance department. Answer: A. Compensation for the transaction. FINRA rules require an associated person to provide written notice to their employing broker-dealer before engaging in any private securities transaction, which is the sale of securities outside the regular scope of the representative's employment. However, the rule requires the firm to specifically approve the transaction in writing if the registered representative is to receive any compensation for the sale. If compensation is paid, the firm must supervise the transaction as if it were on the firm's books. Therefore, receiving compensation triggers the highest level of scrutiny and approval from the firm. Question 19. A broker-dealer that sells only open-end investment company shares and variable annuities would be required to register with the SEC as a broker-dealer and also with A. the Municipal Securities Rulemaking Board, MSRB. B. the Chicago Board Options Exchange, CBOE. C. FINRA. D. the Federal Reserve Board, FRB. Answer: C. FINRA. All broker-dealers that transact business in securities with the public must register with the Securities and Exchange Commission, SEC, and most are also required to become members of a self-regulatory organization, SRO, with FINRA, Financial Industry Regulatory Authority, being the largest. FINRA regulates the conduct of its member firms and their associated persons, including those selling mutual funds and variable annuities. The MSRB regulates municipal securities, while the CBOE is focused on options trading, neither of which are exclusively applicable to this type of firm. Question 20. The primary investment objective of a money market fund is A. Maximum capital appreciation. B. High current income from bond investments. C. Stability and liquidity. D. High growth with moderate risk. Answer: C. Stability and liquidity. Money market funds invest in short-term, highly liquid debt instruments, such as U.S. Treasury bills and commercial paper, with the central objective of providing stability of principal and immediate liquidity to investors. These funds maintain a stable net asset value, NAV, of typically $1 per share, meaning they are considered the safest type of mutual fund, though they are not federally insured like bank accounts. While they do generate income, the focus is on safety and accessibility rather than high yield or capital growth. Question 21. If a mutual fund shareholder chooses to reinvest dividends and capital gains distributions, how are these reinvested funds taxed? A. They are tax-deferred until the shares are ultimately redeemed. B. They are tax-free because no cash was received by the investor. C. They are currently taxable to the shareholder as ordinary income and capital gains. D. They are taxed only when the fund's NAV increases by the amount of the reinvestment. Answer: C. They are currently taxable to the shareholder as ordinary income and capital gains. Even when a mutual fund investor chooses to reinvest dividends and capital gains distributions back into additional shares, the distributions are considered a taxable event in the year they are received, just as if the investor had taken the money in cash. Dividends are generally taxed as ordinary income, and capital gains distributions are taxed as capital gains. This is an important distinction to explain to clients, as the benefit of reinvestment is compounding, but the tax liability is not deferred. Question 22. Which of the following is considered a non-taxable transfer of assets from one retirement account to another? A. A transfer of funds from a 401k to a non-qualified variable annuity. B. A direct rollover from a traditional IRA to a Roth IRA. C. A 60-day rollover from one IRA to another IRA, once per 12-month period. D. A lump sum distribution from a qualified plan taken in cash by the participant. Answer: C. A 60-day rollover from one IRA to another IRA, once per 12-month period. A 60-day rollover is a non-taxable event that allows a participant to withdraw funds from a qualified retirement plan or IRA and deposit them into another qualified plan within 60 calendar days without incurring immediate income tax or penalties. However, this type of rollover is limited to one per participant across all of their IRAs within any 12-month period. A direct rollover avoids the 20% mandatory federal tax withholding that occurs when a check is made out to the participant, which is a safer method of moving assets. Question 23. The assumed interest rate (AIR) within a variable annuity contract is used to A. Guarantee the maximum rate of return the contract will earn during the accumulation phase. B. Calculate the value of the accumulation units. C. Determine the initial value of the annuity unit and serve as a benchmark for subsequent payout fluctuations. D. Set the minimum guaranteed death benefit offered by the policy. Answer: C. Determine the initial value of the annuity unit and serve as a benchmark for subsequent payout fluctuations. The assumed interest rate, AIR, is a projection of the return needed on the separate account to maintain a level annuity payment. It is not a guarantee of earnings. The AIR is used by the insurance company to calculate the initial value of the annuity unit and then acts as a benchmark against which the separate account's actual performance is compared to determine the value of the next annuity payment. If the separate account's return is greater than the AIR, the next payment increases. If it is less than the AIR, the payment decreases. Question 24. A registered representative is prohibited from sharing in the profits and losses of a customer's account unless which condition is met? A. The customer is an immediate family member. B. The transaction is in a variable annuity and not a mutual fund. C. The representative has contributed capital to the account. D. The representative has received written authorization from the firm and the sharing is proportionate to the capital contributed. Answer: D. The representative has received written authorization from the firm and the sharing is proportionate to the capital contributed. FINRA rules strictly prohibit an associated person from sharing in the profits or losses of a customer's account unless the firm has provided prior written authorization and the sharing is in direct proportion to the financial contribution made by the representative to that account. An exception exists for sharing with immediate family members, where the sharing does not need to be proportionate to capital contributed, but written notice to the firm is still required. The rule exists to prevent conflicts of interest and to ensure representatives do not improperly guarantee returns. Question 25. Which of the following statements about a unit investment trust (UIT) is true? It is a managed portfolio of securities that actively trades its holdings. B. It is an open-end investment company that continuously offers new shares. C. It issues redeemable shares and terminates on a specified date. D. It trades on an exchange like a stock, and its price is determined by supply and demand. Answer: C. It issues redeemable shares and terminates on a specified date. A unit investment trust (UIT) is characterized by a fixed portfolio of securities, meaning the portfolio is not actively managed and generally remains unchanged for the life of the trust. UITs issue redeemable shares to investors, similar to mutual funds, but the trust is designed to terminate on a specified date when the portfolio is liquidated and the proceeds are distributed to the unit holders. The fixed nature and the set termination date are the key identifiers of a UIT structure, which offers simplicity but no active portfolio adjustments. Question 26. A registered representative must determine a customer's suitability before recommending a variable annuity, particularly concerning the client's existing insurance policies and life expectancy. B. Tax bracket and investment time horizon. C. Educational background and professional experience. D. Marital status and number of dependents. Answer: B. Tax bracket and investment time horizon. Variable annuities are often most suitable for investors who have already maximized contributions to other tax-advantaged retirement plans, are in a high tax bracket, to benefit from the tax-deferred growth, and have a long-term investment time horizon to allow for market fluctuation and to mitigate the effect of high surrender charges. Due to the high fees and potential surrender charges, recommending a variable annuity to a client who needs immediate access to their funds or has a short time horizon would likely be an unsuitable sale. A representative's due diligence must focus on ensuring the product's long-term features align with the customer's financial needs and goals. Question 27. The calculation of the net asset value, NAV, of a mutual fund is required to be performed at least daily, B. weekly, C. monthly, D. quarterly. Answer: daily. Mutual funds, which are open-end investment companies, are legally required by the Investment Company Act of 1940 to calculate their net asset value, NAV, per share at least once every business day, usually at the close of the major stock exchanges, 4 p.m. Eastern Time. This daily calculation ensures that investors are always able to purchase or redeem shares at a current and accurate price, following the forward pricing rule, where orders received are executed at the next calculated NAV. The NAV calculation is critical for maintaining market transparency and fairness for all investors. Question 28. Which of the following is a potential risk associated with investing in a closed-end investment company? A. The price of the shares may trade at a significant premium or discount to the net asset value, NAV. B. The investor may be forced to pay a contingent deferred sales charge, CDSC, upon redemption. C. The fund's portfolio is unmanaged and fixed, leading to limited growth potential. D. The fund may charge a high front-end load that significantly reduces the initial investment. Answer: A. The price of the shares may trade at a significant premium or discount to the net asset value, NAV. Closed-end funds trade on an exchange like stocks, meaning their price is determined by market supply and demand, not by the fund's net asset value, NAV. This characteristic introduces the risk that the shares may sell in the secondary market at a price significantly higher, a premium, or lower, a discount, than the underlying value of the portfolio per share, which is the NAV. The possibility of this premium or discount is a unique risk factor for closed-end funds that does not exist for open-end funds, which always trade at the NAV plus any applicable sales load. Question 29. When a variable annuity owner decides to annuitize the contract, the investor is essentially choosing to A. Take a lump sum withdrawal of the contract's entire value. B. Reinvest the accumulation units into a different subaccount. C. Convert the accumulated value into a stream of periodic income payments. D. Transfer the entire account to a different insurance carrier tax-free. Answer: C. Convert the accumulated value into a stream of periodic income payments. Annuitization is the process where the contract owner converts their accumulated cash value, represented by accumulation units, into a stream of regular income payments that will continue for a specified period or for the rest of their life. This process marks the transition from the accumulation phase to the payout phase, and once annuitization has occurred, the investor can no longer take lump sum withdrawals of the principal. Annuitization is the core function of an annuity contract, transforming a pool of assets into a retirement income stream. Question 30. All of the following are generally required for a mutual fund to offer a breakpoint to an investor, except the investment is made by a single person or defined group, such as an immediate family or corporation. B. The investment is made over a one-time purchase. C. The reduced sales charge is clearly disclosed in the fund's prospectus. D. The sale is made in accordance with the fund's published schedule of sales charges. Answer: B. The investment is made over a one-time purchase. A breakpoint is a schedule of reduced sales charges based on the amount of money invested, and investors can qualify for it through a large, single purchase, or by signing a letter of intent, LOI, to reach a threshold over a period of up to 13 months, or by using rights of accumulation. Therefore, a large one-time purchase is not required, as the LOI allows for multiple, smaller purchases to qualify. The reduction in sales charge must be available to all investors and fully disclosed in the prospectus. Question 31. An open-end investment company is prohibited from selling its shares short or borrowing money from banks in excess of what percentage of its net assets? 10%. B. 25%. C. 33 1/3%. D. 50%. Answer: C. 33 1/3%. The Investment Company Act of 1940 places specific restrictions on the operations of mutual funds, including limiting their ability to borrow money to no more than 1/3, 33 1/3%, of their net assets. This conservative borrowing restriction is in place to protect shareholders from excessive risk that could be introduced through high leverage. This rule reinforces the idea that mutual funds are designed to be investment vehicles with reasonable, diversified risk levels. Question 32. A broker-dealer must establish, maintain, and enforce written procedures to supervise the activities of its registered representatives, which is known as A. Suitability requirements. B. The Books and Records Rule. C. An anti-money laundering program. D. Supervisory control procedures. Answer: D. Supervisory control procedures. Broker-dealers are required by FINRA rules to establish, maintain, and enforce a system of written supervisory control procedures, WSPs, to ensure compliance with all securities laws and SRO regulations. This comprehensive system covers all aspects of the firm's business, including review and approval of customer accounts, communications and transactions, with the core goal of protecting the investing public. This framework is essential to a firm's adherence to its legal and regulatory obligations. Question 33. Under FINRA rules, all retail communications concerning variable annuities must clearly explain that the contract's investment return and principal value A. are guaranteed by the insurance company's general account. B. are not guaranteed and fluctuate with the performance of the separate account. C. are guaranteed to be at least the assumed interest rate AIR. D. are insured by the Securities Investor Protection Corporation, SIPC. Answer B. are not guaranteed and fluctuate with the performance of the separate account. Due to the complexity and potential for misunderstanding with variable products, FINRA Rule 2210 requires that all retail communications regarding variable annuities prominently state that investment returns and principal value are not guaranteed and can fluctuate, based on the performance of the underlying separate account. This disclosure is mandatory to ensure investors understand they bear the investment risk, contrasting with the guarantees associated with a fixed annuity, which is funded by the insurance company's general account. It is crucial for representatives to clearly distinguish the risk profile of variable products. Question 34. The maximum annual contribution an individual may make to a 403(b) retirement plan is determined by A. the plan participant's employer, B. the Investment Company Act of 1940, C. the Internal Revenue Service (IRS) contribution limits, D. the plan's designated investment manager. Answer: C. the Internal Revenue Service (IRS) contribution limits. The annual maximum contribution limits for 403(b) plans, which are tax-sheltered annuities primarily for public school employees and nonprofits, are set by the Internal Revenue Service (IRS) and are subject to change annually. These limits are part of the broader tax code that governs qualified retirement plans and are designed to provide tax advantages while placing a cap on the amount of tax-deferred savings an individual can accumulate each year. Registered representatives must remain current on the annual IRS figures. Question 35. A municipal bond fund invests in municipal securities, and the interest received by the fund is generally A. taxable at the federal level but exempt from state and local taxes. B. tax-exempt at the federal level, but may be subject to state and local taxes. C. exempt from all federal, state, and local taxes, regardless of the investor's residence. D. fully taxable at all levels, similar to corporate bond interest. Answer B. tax-exempt at the federal level, but may be subject to state and local taxes. Municipal bonds and the interest income they generate for a municipal bond fund are typically exempt from federal income tax. However, the interest may still be subject to state and local income taxes unless the investor resides in the state where the bond was issued, which is known as double tax-free status. It is critical for the representative to explain this nuance, as the tax-exempt status of the interest is the primary reason for investing in these specialized funds.